This is part one of topic 6, microeconomics of financial markets, and this topic is really a transition topic between microeconomics and macroeconomics. It's microeconomics in the sense that we're looking at interest rates, and interest rates are a price, they're the price of money, so they're driven by the forces of demand and supply. And it's macroeconomics because interest rates are a key part of monetary policy, as we'll see later on in the course. So in this topic we're looking at things such as interest rates and debt markets, short-term debt, long-term debt, and short and long-term interest rates. Now, the debt markets that we are looking at here are known as wholesale debt markets, not retail debt markets. So the types of economic agents that are active in wholesale debt markets are governments, financial institutions, big companies, and then on the provision of savings side, we're looking at big organisations that have excess savings to provide to these debt markets. So sometimes that's governments, sometimes it's companies, but also big superannuation funds, that sort of thing. So I don't want you to think of these debt markets as involving you and the bank. That's a retail debt situation. This is a wholesale debt market, and the distinction will become more obvious as we work our way through this topic. Okay, so first of all, direct financing. Very often companies need money to finance investment spending or even day-to-day working capital. Now, there's 3 different places that companies can actually obtain direct financing. The first is short-term debt markets, the second is long-term debt markets, and the second is the share market. We're going to be focusing on numbers 1 and 2, short-term debt markets and long-term debt markets. The reason being is that both short-term and long-term debt markets have interest rates associated with them, and those interest rates are driven by the forces of demand and supply. So if you go into a short-term debt market, there will be, and to borrow money, there will be an interest rate that you'll have to pay, and that interest rate will be determined by demand and supply factors. Okay, so the market for loanable funds, this should be reasonably familiar to you now. We've got a demand curve for loanable funds and a supply curve for loanable funds, and I've got it there an interest rate of 6%. Now, in this market for loanable funds, when money in this market is actually loaned, it creates a debt, and so effectively this market for loanable funds is a debt market. Now, the distinction we're making in this topic is that there are short-term debt markets, basically for borrowing of 1 year or less, and long-term debt markets, which is borrowing of over a year. In this next slide, we've got the supply curve for loanable funds shifting out to the right. That drives the interest rate down. It's important that you focus on the intuition of these sorts of diagrams. So an increase in the supply of money available for lending, that is loanable funds, drives the interest rate down simply because there is more money in financial markets. Now, what I've drawn here is just one market, one particular market. In the real world, there are thousands of different debt markets, and they differ depending upon the term of the lending. So some lending is as short as 24 hours, some lending as long as 30, 40, 50 years. And then the second way they differ is the credit rating of the borrower. So the Australian government, for example, is AAA rated. And then you've got some mid-sized companies who might be BBB rated. So depending upon the quality or the credit rating of the borrower, we have different debt markets for each different credit rating. Okay, so one of the big important distinctions that we'll make here is the term of the lending. So we're in wholesale debt markets here, not retail debt markets, wholesale debt markets, and we've got different terms of loans, and I've just drawn in some of the more common ones. There's certainly, what I haven't drawn here is say for example 2 years or 4 years. There are certainly 2 and 4 year markets. I've just drawn some of the more common ones on this timeline. What this timeline represents is the fact that there is lending for 1 day, there is lending and borrowing for 30 days, 90 days, 180 days, and it goes right up to 30 years. And it actually goes beyond 30 years. When we hit the 30-year point, we are in the bond market. We're talking about bonds, and there is even a 100-year bond market. Not too many 100-year bonds have been issued, but they have been issued in the past. So when companies, governments go into wholesale debt markets and borrow for less than a year, we're going to say they have entered short-term debt markets. And when governments, companies go into wholesale debt markets to borrow for more than a year, we will say that they have entered the long-term debt markets. Now, one important, very important market that we'll be learning about more in this topic is the overnight cash market. And that is the market through which the Reserve Bank of Australia operates monetary policy. And that overnight cash market, we'll be learning a lot about how that actually works. That is a 24-hour market. So typically financial institutions are the main players in that market, and they borrow money from each other overnight. If you go into the bank, your local bank, Commonwealth or Westpac, and ask for a $500,000 loan to build or buy a new home, then the bank will typically enter these debt markets to borrow $500,000 on your behalf. So how would they do it? They may go into the 3-year bond market and borrow $400,000, and they may borrow the remaining $100,000 in the 90-day short-term debt markets. So that's typically the way it works. Typically in Australia, banks don't have enough savings from customers to satisfy all of the lending they want to do. So at the margin, if any new business comes along, banks in Australia need to enter these types of wholesale debt markets to borrow money to then lend to you, the customer. Same sort of thing with companies, BHP, Rio Tinto. If they want to borrow a large amount of money to undertake a new project, they will enter these long-term debt markets and borrow the money there. If they want to smooth out their cash flow and just need a little bit of short-term money to use as working capital,